What if I inherited an IRA from my parent? If you have recently inherited an individual retirement account from your parent, you might be wondering what steps to take next. Understanding the rules and options available to you is essential for effective retirement planning. The treatment of the inherited account largely depends on whether you are a spouse or a non-spouse beneficiary, the type of account inherited, and your parent's age at the time of passing. First, as a beneficiary, you will need to transfer the assets from your parent's individual retirement account into a new account set up in your name. This is often referred to as a beneficiary individual retirement account. The tax treatment of the inherited account will remain the same as the original account. Traditional individual retirement accounts will continue to be tax deferred, while Roth individual retirement accounts will allow for tax-free distributions if certain conditions are met. Now, let's talk about required minimum distributions. If your parent had started taking required minimum distributions before they passed away, you, as a non-spouse beneficiary, will generally need to take annual distributions starting the year after their death. The amount you must withdraw is based on your life expectancy or under the 10-year rule, depending on when your parent passed away. If your parent died before reaching the age to start required minimum distributions, which is currently age 73, you may not need to take annual distributions. However, you must fully distribute the inherited individual retirement account within 10 years of their death. Starting in 2025, new rules will requiring many non-spouse beneficiaries to begin taking annual required minimum distributions if the original owner died after their required beginning date. The full balance of the account must be distributed within 10 years of the original owner's death. For spouses, there are more options available. You can treat the inherited individual retirement account as your own by rolling it into your own account, which allows you to delay required minimum distributions until you reach age 73. Alternatively, you can keep the account as an inherited individual retirement account and delay required minimum distributions until the deceased would have turned 73. You also have the option to take a lump sum distribution, which would be fully taxable if the account is a traditional individual retirement account. If your spouse had already started required minimum distributions, you can begin taking them based on your own life expectancy. When it comes to tax implications, distributions from inherited traditional individual retirement accounts are generally subject to income tax. Roth individual retirement accounts, if held for the required period, allow for tax-free distributions. It is important to plan your distributions carefully to manage your tax impact during retirement. Keep in mind that inherited individual retirement accounts cannot be combined with your own accounts. They must remain separate. The 10-year rule limits how long you can stretch distributions, which may increase your taxable income compared to previous rules that allowed for lifetime stretching. Careful planning is necessary to avoid penalties from the Internal Revenue Service for missed required minimum distributions, which can be quite severe. As you navigate this process, consider your own retirement timeline and tax bracket when deciding how and when to take distributions. Naming beneficiaries for your inherited individual retirement account is also important to maintain tax advantages for future generations. Inheriting an individual retirement account from your parent requires understanding the distribution rules, tax consequences, and timing to effectively integrate it into your retirement planning.